Debbas right now, the Debbas managing partner. Pierre, the premise of the article is kind of the stuff that you and I have talked about in prior chats: interest rates backing up, skittishness building up, a perfect sort of confluence of events to sort of come off our rocket high levels. What do you think?
You know, when you're alluding to the luxury market, Neil, in terms of, what the pricing is going to be there, we had, one of the biggest surprises of COVID, obviously, was generally the, robust increase in value of the housing market, but also, too, how much money would gravitate towards the luxury market. And, one of the interesting things was the level of wealth that was created during the pandemic through today. And one of the biggest beneficiaries has been the real estate market, with the luxury market being a massive, massive beneficiary given the relocation and the flexibility that the world has become accustomed to. You're looking at the demand for second homes; it's roughly doubled since from pre-pandemic levels. How does that make sense? It only makes sense given the fact that in this virtual hybrid world we live in, people are able to utilize that asset far more than they would have been, in 2019 and the way the world was beforehand, and so much money went there. But that's going to slow down because inevitably it has to. And also right now, big part of the reason you're going to see that slowdown is the turmoil going on in the world. Interest rates are up, like we discussed before, a substantial sum. Stock market volatility has been, insane the last several months. So you're starting to see the trickle effect, especially in the luxury market.
Well, then you worry about a trickle down, right? And whether those who heretofore were leading it hold back and step back. I understand that in the interim there might be a mad dash to get what you can while the getting's good. But what happens after that?
We saw that in Q1 of this year, a huge dash to buy anything you can possibly get your hands on to preserve that low interest rate that we saw in the beginning of the year. Now, Q2, you're going to see that, slightly impact Q2 and Q3, Q4. I anticipate a significant slowdown in activity. I don't think pricing is going to come down that much because we still have a supply issue. However, it's going to result in a real big drop in activity because what's going to prompt you to sell if you have not already? In reality, if you were going to sell, capitalize on the market, you would have done so by now. And then if you have to sell and upgrade, relocate, transition to somewhere else, right now, rentals are all-time high. And with interest rates probably being double what you refinanced at 2 years ago, I don't see the incentive to bring on, your property into a market unless you have a life event that forces you to.
Or you're just interested in doing something different. That'll be the big test. Pierre, thank you very, very much. I apologize for the truncated time with all this breaking news. Pierre Debbas, the Debbas managing partner.